So, hey everybody, it's Leo once again with another backtesting session. This one's going to be more of a futures focus for today, and then I'll potentially do another backtesting session tomorrow based on the option side. Decided I kind of want to break them into two separate live sessions just for information load. That way you guys, especially your premium members, can review each of those live streams separately rather than having them all compiled into one big video. But let's get started here, right? So we're going to do a little bit of a futures live stream session, kind of go through my process when I'm taking these trades, how I utilize the fractal model when I'm entering and exiting trades. And yeah, so that's kind of what it's going to be for today. So first and foremost, when I do backtesting sessions, it's going to use a lot of previous market data, and we're going to see whether or not my system, my trading system aligns. So whether or not all my criteria fits properly and that I do see potential trades set up and play in my favor based on my trading strategy. And so a lot of you know from my previous live sessions, you know that I utilize a mix between the fractal model as well as some supply and demand and utilize liquidity sweeps as my primary for my trading model. So let's go into NASDAQ as my first example here for this recap. And we see here on the daily with NASDAQ, we'll just let this play out just a little bit here. So I'll break it down time frame by time frame, and then I'll actually show my entry model on the 3-minute and the 5-minute time frame. So right off the bat here, what did we notice with last week's market? Well, with this Monday open, we had quite an interesting week, right? We had an FOMC week, and so it was definitely not an ideal week in terms of price action. You know, Monday and Tuesday yielded some pretty good price action, but Wednesday and Thursday, as well as Friday, had some pretty rough PA. As I'm sure a lot of us noticed, market was not the easiest to trade, and setups were pretty limited. And so let's just look at this, right? So on that Friday close, what did we see market do? Well, market actually closed with an expansion candle on the daily time frame. What do we see when we have an expansion? Well, we saw this, right? On this Wednesday close, we saw an open, low, high close candle where this Wednesday closed, this Thursday had a continuation lower, and then Friday actually had an expansion higher, breaking above the candle body of that Thursday and Wednesday of last week's candles. So what am I anticipating now with market going into the next week? Well, with Monday, I was actually anticipating a move higher. Since we created an expansion candle on the daily, we can typically expect a 1 to 3 candle, or since this is the first expansion, we can typically expect a 1 to 3 candle expansion on the daily time frame, which is what I was looking at here. And so on Monday, if we break this down on a 4-hour time frame, well, we were looking exactly for that, where we were looking to see market expand higher on that Monday, with Monday's market. And so here we go. Let's just break this down properly here. We've got Monday of this week, right? So we'll just break this down, make sure we close out Sunday and Monday as separation. And so this here, anything past that red line is going to be the new week, right? So with Monday, what did we see happen on the 4-hour time frame? Well, we actually did have an expansion higher on Monday with a nice close, approximately, what is that? About 300 points higher with that Monday close. So did get that Monday expansion, and so a couple of those trades yielded. But we're going to actually break it down from Friday's trades and move backwards in time and just test different time frames to see what worked and what didn't work for this trade. So on the 4-hour time frame, if we just break down Friday, we had these two beautiful 4-hour expansion candles. As you see here, this candle right here, right, this Friday 6 o'clock to 10 o'clock 4-hour candle actually yielded a reversal signature. Why would that be the case? And this is one of the big things I was looking at when I was watching the charts on Friday for a potential trade, was to see whether or not we would get an expansion, a potential expansion and delivery lower, or if we were going to show any sign of a reversal signature off of this previous day liquidity. And here we see, right, what did we form down here? Well, we actually formed beautiful liquidity down at this range. And so what I was watching to see market do on a higher time frame was to see a potential sweep of this liquidity prior to showing some type of reversal signature and an expansion higher. And so here, once again, I drew out my liquidity, and this liquidity was from this Tuesday 10 a.m. candle. This was the 4-hour low, right? And so all throughout here, we're kind of testing in between, watching markets sweep these Monday highs in terms of liquidity and showing anticipation and delivery lower. And then on Friday, which is what I'm going to break down first for my trade, we see this beautiful reversal signature form off of a liquidity sweep on the 4-hour. So what can I expect, right? If I were to break this down and just break down these 4-hour candles, well, we see that this market on this 4-hour time frame retested this liquidity, filled these liquidity, so whether it was these buy stops or these market orders, and then showcased a much smaller candle body than this actual wick run. And as we know with candlesticks, when you have a much larger wick than the actual candle body, that's typically sign for a potential reversal signature. You can see this as a common trend with market because we see here, once again, we had closed with a very small bearish candle body, and then this market open ended up having an expansion higher prior to a delivery lower. And so just looking at general market trend, these can signify really good reversal signatures, and this candle body, due to it being larger with a very large wick run, gave me the anticipation that market was going to potentially move higher. And so if I break this down on the 1 hour now, we saw that that was that 4-hour open. What did we see happen at this 1 hour liquidity? Well, on this 1 hour time frame, we actually filled that liquidity to the cent on the hourly time frame, and we closed with an hourly reversal signature candle. And so anticipating some type of delivery higher was what a lot of my friends and myself are doing. And look what happens when we play out this next hourly candle. Well, we had a reversal form with a where we respected 50% of that candle wick and expanded higher. So this actually played out perfectly in terms of that reversal signature. Once again, respected that candle and continued higher with this delivery. And so here's just a little bit of a recap as to what Friday's anticipation was for me. And we can see here that Friday actually yielded a beautiful expansion higher off of that liquidity sweep. So how did I actually take a trade now on Friday's market? Well, we'll break this down into the 3-minute time frame, since that is typically where with my entry model with the Fractal, I like to enter on the 3-minute or the 5-minute time frame after I have aligned a higher time frame key levels, right? And so as I mentioned with that 4-hour and that 1 hour liquidity, we filled this 4-hour and 1 hour liquidity on the 5-minute and even on the 3-minute time frame here, right? And so now I'm trying to watch for a potential reversal signature on a higher time frame. And so as my model goes, and as the fractal goes, which is what I utilize, but we're just saying my model in this case, what am I looking for primarily, right? So let's do entry model. I'm going to write this down as an entry model. When I'm looking for an entry model, I want to see a couple things form here. First of all, I want to see a sweep of liquidity. So this could be anything like previous highs. So previous highs, and I'll write this down for you guys, previous highs and lows, as well as potential, areas of liquidity. So I'm just going to write that as LQ. So the first thing I want to see is some type of a sweep of liquidity on a higher time frame that aligns with a lower time frame. And so on that 4-hour and 1 hour candle, we saw that liquidity from that Tuesday and Wednesday market had been filled. And we can see it here even with my cursor on Friday at around 9:24 and as well as 9:36. We had this sweep of liquidity. Now, what do I want to see as well? Well, typically, if you want a higher percentage chance of a trade working out, you want to try and find some type of SMT divergence, right? An SMT divergence between a correlating asset. And if we're talking about NQ, we want to find some type of SMT divergence between ES if we're talking about NQ, and NQ if we're finding a trade with ES. So we want to find, first of all, that sweep of liquidity, a previous high and low, an SMT divergence, and then my favorite is a change in state of delivery on either the 3-minute time frame, the 5-minute, the 15, and sometimes even the 1 hour. And I take my entries on the 3-minute or 5-minute time frame, right? And so we're just going to leave this up. Oh, where did that go? There it is. So we're just going to leave this up here so you guys can see this during the lesson. But this is the primary entry model that I'm looking at when I'm taking these futures trades, right? And so once again, on that hourly time frame, what did we see with ES, right? We saw this liquidity get swept on the 1 hour time frame. And what else did we form? Well, we formed a beautiful entry signature on this 3-minute, which I'll go over in just 1 second here. And so what happened with market, right? And so yes, there's a couple different things we can backtest here. I'm just going to break this down just in terms of NQ, and then I'll give an example with that SMT divergence that I had taken later in the day on Friday that yielded a beautiful 2 to 1 hour trade. But let's break this through first. So we see here that we have swept liquidity on the 4-hour, the 1 hour time frame, and now I want to find alignment on a smaller time frame, like the 3-minute time frame. Okay. So this 3-minute time frame, we see liquidity swept. Well, what else can we find here? Now, the biggest thing I'm trying to find, and the SMT divergence, I'll give an example next, but we'll just look at the change in state of delivery right now. We are on the 3-minute time frame, and if we were to draw the candle body, we have swept liquidity on that 3-minute time frame and have created this 2-candle down closure here, right? And so this right here would be your considered change in state of delivery, right? We have 2 candles, we had swept liquidity and had a 2-candle down close followed by a continuation higher. And so if I just use this replay tool here, and we'll just take this bar and we'll go right here. We've now followed 2 things within my system, right? We have found some type of sweep of previous liquidity on that hourly and 4-hour, and now we are pairing it with a change in state of delivery on a smaller time frame. And so with this 3-minute, we've drawn this out. And so where am I looking to take my entry? Well, with my entry primarily, I want to see a candle body, a bullish candle body closure above this change in state of delivery to potentially see a continuation higher. And so we'll let this play out here. And the second we see a candle body closure above that change in state of delivery is when I would take my entry on that 3-minute time frame. So we'll let this next candle play out and look what we have here. We have a beautiful 3-minute closure above that change in state. And so as a lot of you can probably anticipate, because we filled this liquidity down here and we closed on this bullish change in state of delivery, I am anticipating a move higher on the on NASDAQ, right? I'm anticipating price to move higher, potentially filling out liquidity up around here on this 3-minute time frame. So we can even draw these out just for the sake of it, right? Because before you enter any trade, it's really important that you take a look as to where price can potentially go. Because if you enter a trade and liquidity ends up being right here and you get stopped out of a position, well, that's because you entered a trade blindly without actually looking at where the trade could potentially go. And look at what we see here. Well, we have 2 great examples of liquidity on this lower time frame here. And so I'm just going to mark these out as a potential take profit zone for this trade. But as I mentioned here, we had this candle body closure on the 3-minute change in state of delivery. So I am now entering a long position with anticipation of a 2-to-1 trade. So where would I put my stop loss? Well, my stop loss is always going to be at the candle body base of a change in state of delivery. So if I were just to line this up, this 2 candle body closure, I'm lining up my stop loss with this base candle, because that means if market were to retrace back below this change in state of delivery low, we can anticipate that market is just not going to move any higher and is just going to have a continuation lower. And so this change in state of delivery would be considered invalid. But let's look at this now, right? We've created this change in state, we have a closure, and we enter on that closure on the 3-minute time frame. Some people as well might even move to the 1 minute, but I prefer the 1 minute. I prefer the 3 minutes since it's a little more stable of a time frame. Let's say I've entered now. Well, what's the next thing with my trading policy? I'm going to write this out. When I enter on the 3-minute, I'm always looking for a 2-to-1 risk to reward ratio on these trades. And so here we have now entered this trade and we currently have a 0.86 risk to reward, which is not good, right? That means that for every $1 we're anticipating, every $1 we're risking, we're trying to make 86 cents, which is not good, right? That gives you a less than 50-50 chance of winning a trade. And so what do I want to do, right? If I'm just anticipating a good trade to play out, I'm anticipating a 2-to-1 risk to reward ratio. So I'll just drag my take profit here until I hit that 2-to-1 risk to reward. And so in this first trade scenario, I want price to hit my maximum take profit here. And so let's say I've entered the trade on this. My take profit now is going to be at that 2-to-1, so $2,085 with a risk of $1,055. Right? And so now I have set up a trading criteria. I have a 2-to-1 risk to reward ratio. We have swept liquidity on a higher time frame and have aligned it with a smaller time frame, aka the 3-minute. I have now put my stop loss in place. So this is now a trade that has a given risk as well as a potential given profit to be hit. And I have my potential take profits that are higher than my 2-to-1 risk to reward. And so here we see the stop loss is in place, this take profit is in place, and now if I wanted to, and let's say I entered with multiple contracts, so more than one contract, I'm going to sell out of most of my position at that 2R right up here at 19,782. But if I wanted to, and if I was in with more than one contract, I could potentially anticipate market going even higher up towards this liquidity at 19,830, right? And so this is just a potential example. So I'll actually draw this out as well for you guys. So we'll just pretend I took a secondary contract entry with the same stop, right? Always at the base of that change in state. And except my target now is going to be at this liquidity up here at 19,830, which yields me a nearly 3-to-1 risk to reward ratio, right? So now we're just going to let this trade play out, and we're going to see if, because we've matched all our criteria, we want to see if whether or not this trade gives us our hit profit goal, and to see if potentially our runner even goes higher to a potential 3-to-1 risk to reward. So I'm just going to actually move this one a little bit to the side here so we can let this main trade play out. And let's just let this trade play out now, shall we? So we'll see here, right? So market continues higher. We are still respecting that change in state of delivery. We tapped back at a break even, but we still continued higher. Okay, we're just gonna let this trade continue, right? We're still getting full confirmation of bull side. There's still no reason to exit this position, right? We are still respecting the change in state of delivery. We have our given risk, okay? So we're just gonna let this trade continue. Market is still not giving us any signal that we have still fully respected that change in state, right? There's no reason to be afraid of exiting because we have our given risk, right? So we're just going to let this trade continue to play out. I'm just going to keep hitting this next button. And so here we go. We are given that confirmation. Okay, we still have that bull confirmation. Market has not quite hit our 2-to-1 risk to reward. So we're just going to wait to see if this plays out eventually, right? So we'll just keep playing this out, even if we're in this trade for a while. And there we go, right? Our take profit hit at that 2-to-1 risk to reward ratio. Okay, and so this trade, it fully respected, and this is what a lot of traders tend to mess up on. They tend to see a little bit of red and they exit a position and then always wonder why the position ends up going in their favor later on. And the main reason is because those traders don't realize that when you have a given setup and you are confident with your system is most likely going to play out, right? And with this example of pairing this higher time frame and smaller time frame liquidity sweep with that change in state of delivery, and we'll go through an SMT example in a second, this is a very high confidence trade for myself. And as you all can tell here, this trade played out perfectly with a 2-to-1 risk to reward ratio, yielding us a $2,085 profit, or if you're using a micro contract, would have been a $208.50 contract, or $208.50 of profit on a micro contract. And so this is a perfect A+ quality trade that actually played out for us and yielded that 2-to-1. So now let's do the same example once again. And now we're anticipating this liquidity to be swept up here at these 3-minute highs, these short-term highs, right? So let's just let this play out and see if we actually hit this and potentially get a potential 3-to-1 risk to reward, right? Because still we have no signature of potential downside. We haven't hit any change in state. This would have been considered a change in state. We still have respected that, right? And so currently, let's see if we at all hit this, right? If you were to stay in a trade like this for a while, okay? And so in this example here, you probably would have been out of a position. You would have already been out, but let's say you were just holding a runner as potential. Well, look what happens here. Boom. You're still in this trade because if I were just to extend this original entry here, look at what happens, right? You still are risking the same amount. You've still respected this change in state of delivery. You haven't hit below this change in state. So you know that market still has potential to move higher. And look what happens here with Friday. Well, we have a continuation up to that, yielding a 3-to-1 risk to reward and even almost a 4-to-1 risk to reward ratio on Friday. And so this is a first primary example of a really well back-tested trade because we hit all of the criteria we were looking for, smashed that take profit, and boom, we had an A+ quality trade. SIST for short right before target hit. Correct. There was a SIST that had formed on the short, but if you, once again, this is why I said it was a runner, right? I was already originally out of my position at that 2-to-1 risk to reward, but yeah, you did have a SIST form on that short term. The thing is, it wasn't really a super valid change in state of delivery, just because we hadn't swept any liquidity, right? We were still within this range, and so that's the reason why you would have stayed confident in this trade, is because this change in state, you're sweeping liquidity that's out of the range, but now you're inside of the range that was created previously during this 8 o'clock to 9 o'clock session. And so if a change in state forms within your internal liquidity or your internal range, it's not as high confidence, right? Change in state is really paired best when you have a sweep of liquidity on a higher time frame, like a more aggressive liquidity where these stops are really being held at this 19,000 area. So this is a back-tested session number 1 where we had a beautiful change in state of delivery paired that had played out. So now we'll move to an SMT example, because I know a lot of you really tend to like these SMTs when they form, right? And so here we have an example where I'm actually going to be using the replay tool on both. Oh wait, I don't know why it's not working for this one here too, but we'll just, here, let me just open up ES itself on this stock, and then we'll have NQ as well. So we'll take another example here near this market close, right? For both NQ and ES, let's just full screen this one here and get this in. So once again, we're going to do the same exact thing for another trade setup. These are our bullish examples. We will cover one bearish example, but these are just two bullish examples that really worked well on Friday. That first trade was a trade I had taken, and I had actually alerted that on the live. And the second trade was a trade I had taken on the evaluation accounts, on my Express accounts. So let's see what we see here with NQ and ES, right? Well, currently we're in what's considered an accumulation phase. And when we see this, it's kind of one of these areas where you don't want to touch market, right? Market is currently trying to accumulate before it decides whether it wants to have a continuation higher or a continuation or a rejection and displacement lower. And so what I'm looking for right now is to see whether or not market tries to fill some type of liquidity and gives me some type of signature for a potential buy model or sell model. Well, let's look at this. We have this accumulation phase. I'm going to mark out this liquidity up here since we do have liquidity that is pooling. So I'm going to mark out this liquidity on this high and a liquidity at this low here, right? Because these are very valid liquidity levels. We see market had aggressive moves below and above each of these, right? And so right now we're in this accumulation phase, not really too much to see. And let's look at ES as well. ES is also in this accumulation phase, right? So we want to mark out these areas of liquidity. Oops, sorry. Let's get this written out here. We've got this area of liquidity 1. And then we'll mark this out too. But what do we notice about the difference between NQ and ES right now? Well, if we take a look just at NQ, NQ is showcasing a lot less bearish strength than ES, right? Because ES almost tagged this base liquidity here and actually ended up tagging this liquidity that we had, this triple candle, this triple wick that had formed here, had actually filled on ES, while NQ had only had a single wick and had filled that single wick. And so, yeah, even though we hadn't filled that base liquidity, we still filled some type of liquidity that had formed from prior market, because this right here could also be considered an area of liquidity on ES, because if you look at this candle wick rejection, it's still rejected above or below that liquidity and continued higher. So these are both areas of liquidity we can look at here within this market scenario. And so here's what I want to look at, right? We've clearly filled, and even though we were in this accumulation phase, ES has officially filled two areas of liquidity. We've filled one area here, second one here, and we're also now in the process of filling a third area of liquidity. And so as a trader now, I'm like, okay, well, we filled 3 areas of liquidity, and now I want to see whether or not we can get any type of buy model that forms, because if we fill this liquidity and market still hasn't made an aggressive move down, I can anticipate a potential move higher on NQ and ES, right? As I'd mentioned here. And I'm going to draw this out on NQ as well, just to keep it simple for you guys on the call. So here we go. Another area of liquidity had formed. And so now I want to look, okay, well, what can I see with NAS and ES? Well, right now we still don't have any buy model that's formed, right? We're trying to see whether or not we get a continuation, but we had filled this liquidity. We're trying to see if we can find a change in state that forms, right? And so what do we notice that happens around here? With NAS, first of all, right? If we just look at this model, we had filled the liquidity down here, and we haven't quite gotten the change in state, but what do we notice here? Well, we filled liquidity and had paired it with a change in state of delivery. Look at that, right? And so NASDAQ actually had a change in state that had formed on this 3-minute time frame. And so here's a potential example, right? And we want to see whether or not we get that confirmation, which we got a candle body close above. But remember, we want to find the correlation between two assets. And so if we were to just look at NQ and ES here, what do we notice about both of these stocks? Well, we actually have an SMT on this 3-minute that formed. Right here, NAS ended up not being able to fill this price. So we'll do an SMT with ES, right? We filled this price, but weren't able to refill it down here. But what do we notice about ES? Well, ES actually managed to completely fill that liquidity down there. Okay, so if I just draw this, maybe I won't label them right now just because it's going to be a little harder to see. But if we just draw this out, what do we notice, right? ES created this low and had filled this liquidity on this low again. But what do we notice about the NAS? The NAS at the exact same time frame, right? If we look down here, we have that 312 candle and that 321 candle. NAS created this low, swept this low, and then did not continue lower. It did not fill this liquidity down here. But look at ES. ES, that same thing, 312 and 321 filled that liquidity down there at those lows. So we created an SMT divergence between two correlating assets, NASDAQ and ES. And so if we look at my original entry model, like I've mentioned before, what are we trying to look for, right? And let's see if we can actually find where I wrote it, which I can't. That's okay. What did I say we're trying to find? Well, we want to find some type of liquidity sweep. And here we clearly have two areas of liquidity that have been swept. We have now found an SMT divergence between two correlating assets, ES and NQ, right? There's our second confluence. And now where could we find our potential third confluence? Well, we have a change in state of delivery because we have filled liquidity at these lows and had created a candle body closure, so a new low that had formed, right? Because the wicks just are the runs, the bodies tell the story of the market. And we have now created a candle body and in this example, a two candle body closure that created and had filled liquidity at those lows. And so now I'm looking and I go, okay, well, ES, SMT, liquidity pooled, liquidity filled, NASDAQ, SMT formed with ES, liquidity filled, liquidity not filled down here, but we still filled some area of liquidity, right? Two areas of high interest liquidity. And now we let this play out. So we finally have this candle body closure, and I'm going to just play this back a little bit. We have this candle body closure that had formed on this change in state of delivery. Here, we're going to draw my long position because as you know, we're always going to enter on the closure of a change in state of delivery with our stop loss being at the lows. And so here's the thing that I wanted to go over on this call. This still would have been a more difficult trade to enter for a lot of people. And the reason being is the risk in this position was a lot, right? Nobody realistically wants to risk 40 points on a trade. And so in a lot of cases, individuals wouldn't enter this trade or try and find some area of confluence like a breaker block that had formed. And so I'll give the first example that if you were to just follow our original model, you would be entering with a stop of about 40 points. And if you're looking for a stop of about 40 points, well, you still need that 2-to-1 risk to reward ratio. So we're going to draw our extension out to this 2-to-1, right? And we'll actually draw it out right here. And let's say we've entered this position now. Okay, so in this example here, and this once again uses mini contracts, our stop loss is going to be at the change in state of delivery lows. So you're risking $805 here, about 40 points, okay? And you are anticipating making about $1,600 exactly, a perfect 2-to-1 risk to reward ratio. And so in this case, 40 points is a lot of risk for a single trade. And so that's what makes it pretty difficult when you're entering a trade like this, because psychologically risking 800 and risking 40 points is a big factor of risk. And so if you're not confident with that, then there's other ways we can approach the fractal model to help you take a trade of higher confluence. But we'll just, in the case of this backtesting session, follow the original fractal model. And so we'll just let this play out right now with anticipation of making those $1,600. And then we'll run through another example on how we can utilize stuff like breaker blocks to help us take an entry with a little less risk. So we're going to let this play out now and see what happens with market. Well, market continues lower. We're still respecting that change in state, and we have a continuation higher, right? Boom. What happened here, right? Well, at around that 3 o'clock window, what happened with market? We had that change in state that was respected. We still did not have any closure below this change in state low, which means that market was still very much so in play for this trade, right? And so with that SMT divergence on NASDAQ and ES, yes, we were down about $400 in that position, but that's the thing about when you're trading is prior to entering a trade, you should feel comfortable risking the amount of money that's within your system. And if you're not, you shouldn't be entering the trade, right? That's a rule of thumb, whether you're options trading or futures trading. You want to make sure that you have confidence in your model and the amount of monetary value that you are risking prior to entering a trade. Because if you enter a trade and then you see yourself down $600 or down $400, or even if it's $20 to $60, right? If you're using a micro contract and you're not confident or comfortable risking that much, you're immediately going to emotionally take these trades, and that emotion is going to affect the way that you outlook market or you perceive market, right? And so this example here, we saw ourselves down about $400 in the red, but we also know the value of this model. The fractal model really focuses a lot on filling liquidity and finding that divergence between NASDAQ and ES, and finding which of the assets are going to be the best to enter. And so here is a perfect example of another 2-to-1 risk to reward. The only difference from this model, the only difference from this trade in comparison to the first trade we backtested, was the fact that this trade did have more risk than the other trade, right? And so in this example, once again, that was a beautiful 2-to-1. But now let's look at ES in the same exact trade, right? We had found that SMT divergence with this liquidity that had been filled. And as we mentioned previously, what did ES have that NASDAQ didn't? Well, ES actually filled even more liquidity down at these lows than NASDAQ did, paired with this change in state, which means that if we got a confirmation above, because so much of this liquidity formed, we could honestly anticipate a more aggressive move higher on ES with that divergence. Okay, so we'll wait to see if we get a confirmation of a close above that change in state and wait for that. So here we go. We have a confirmation above this close. And so we'll get this and we'll get my stop at that change in state of delivery low. Here we are risking 8.75 points on ES, and we want to be shooting for a 2-to-1 risk to reward ratio. Once again, we enter this position on that close with our stop loss at that change in state of delivery low. We are risking $437, and we are anticipating making $875. So an exact 2-to-1 risk to reward ratio. So we're going to let this trade play out now and see whether or not this is a valid trade. And also with this example, we are also risking less because the contract value of an ES contract moves less than that of NASDAQ. And so if you were not comfortable risking $800 to make $1,600, in this trade, you're only risking $437 to make potential $900. So we'll let this play out once again and see what happens with ES. We are down 237. Market has that continuation higher, and we have a beautiful pull up to those highs. And look what we see here. Well, we hit that 2-to-1 risk to reward ratio with that trade taking us out at a perfect 2-to-1 and filled this liquidity up here. And what are we seeing now? We see a potential reversal. And so, yeah, these are two very good bullish examples of NASDAQ and ES, and that is how we utilize the fractal model paired with that SMT divergence at those lows. Once again, let's run this through verbally. Well, what did we see? We marked out our liquidity. We noticed that ES and NQ were in an accumulation phase of market. An accumulation phase is where price has not determined a direction it wants to go, so it's anticipating waiting for one side of the range to be swept, the liquidity on one side of the range to be swept prior to having a move higher or a move lower. And in this example here, ES and NASDAQ decided that it was the right move to continue to fill liquidity at these LQ lows and create this change in state of delivery as well as an SMT divergence on this 3-minute time frame, which gave us a perfect A+ entry model to a 2-to-1 risk to reward trade. So that is two very good bullish examples of NASDAQ and ES. So I hope we enjoyed that. And now we're going to move on to a bearish example. While I'm in between, do we have any questions or no? Feel free to ask away while I'm quickly finding a bearish example on this backtesting. And if not, no worries at all. If we don't have any questions, that's all good too. But if we want to as well, we could also try and find some smaller examples. We have a lot of SMT down here if we wanted to find bearish examples, right? So we're just going to find a couple more of these. And this is a very solid model. You'll see that it actually has a very high win rate. It's above 75% if you do it correctly, right? If you put your stop a lot shorter than that change in state, can you mention when you move to break even if you do? Yeah, of course. So in a lot of these trades, if I'm in with one contract, I typically move to break even if I'm up about 30 to 40 points on a trade. I don't like to move to break even anytime before that. It also depends on the trade. That's a great question though. Actually, I'll run that through really quick. So in this example here, when I'd entered on this long, if I was in a trade, right? If I was in this trade and I was targeting that 2-to-1 risk reward, where am I going to take a break-even trade? In this example, I want to find it once prices move far enough from my change in state of delivery confirmation, right? And so an example, if we had closed above these liquidity highs here, I probably then would have moved my stop loss to break even, or after about 20 to 30 points if we had an aggressive move, right? It really depends on the trade. But yeah, typically my rule of thumb is about 30, 40 points, but I don't tend to move too much. Like I don't take trailing stops or anything on these trades because most of the time it's a high confidence, right? But that's a great question. So we'll go through one more example here, and that's going to conclude the backtesting session. And then tomorrow we'll have a backtesting session with options and option swings. But just to go over another example here, right, we'll just get market, just to go on a replay somewhere here, right? And so once again, right, I'm going to just refresh this market on NASDAQ, but what are we noticing here? First thing we want to do, and I'm just using the shorter time frame. We'll do more of the higher time frame alignment stuff in the future. I just want to talk primarily backtesting the entry model of my trade, right? And so here, once again, we're going to mark these liquidity highs and lows because that's always what you want to be doing in markets, right? So here we have liquidity down here, going to mark down my liquidity as well. And then we also have liquidity that had pooled down here. So I just want to get an even amount of that liquidity both for those highs and lows, because what do we notice about market in this example? Once again, well, we are also in an accumulation phase. NASDAQ had a beautiful run lower here. And what happened next with market? Well, after this run lower, market decided to have a major accumulation phase prior to a potential leg up or a potential leg down. So what do we want to see paired, right? Well, in this example, and then also see if I can get the ES alignment, what do we want to wait for here, right? Well, right now we're still in this accumulation phase and we haven't filled any liquidity on any side. And so right now, a lot of people may have probably tried to take entries because bouncing between the range, you'll see people take short-term positions when you're bouncing in between a range, right? But here's a unique example. We'll just let this play out really quick and see what happens here, right? So here, we saw an aggressive move down from NASDAQ, right? But I myself honestly wouldn't have taken any trade here, even though it looks tempting because we see such an aggressive move down. We had all this liquidity that needed to be filled down here, and we were still in an accumulation phase. And so this is an example where even though, yes, if you'd wanted to, you could have taken, some type of bearish change in state of delivery down here, right? Even though, yes, that is a change in state of delivery because we had created a new high and we had that confirmation. I was not confident in a trade like that because we did not get any liquidity that had filled at those highs or even at the lows. And so in this accumulation, kind of is just a gamble, right? Because it doesn't fit within my entry model. And this trade would have been more of a gamble than an actual confirmed trade. And so this would have been invalidated for me and I would have not taken any short position there, right? Once again, no liquidity was formed or was swept until we had swept those lows. And so that doesn't give me any confirmation to truly enter my position. I like to look for liquidity being swept, especially session liquidity here. So I'm going to turn on my session indicator. And I would like to see some type of session, right? And so here, like sweeping Asia lows is an example, or sweeping Asia highs. Which New York ended up sweeping London lows and then having a reversal, right? And so I want to use different sessions or different lows, but I don't want to be entering in the internal range for liquidity. So let's look at an example up here now, right? And so with my entry model, even though we don't have trades that play out 100% of the time, it still is a potential confirmation, because what do we notice about New York in this session? Well, oops, I don't know why that's not working here. One second. There we go, right? So let's take a look at these Asia and London sessions. With Asia here, we have created a range within Asia prior to this London open, where London had a beautiful reversal. We had a London reversal and then a New York reversal, which was pretty crazy. That's not often you see a model like that play out. but let's just mark out those highs of that Asia session and that Asia low, right? So here we have that liquidity that had pooled at those Asia highs, and we have that Asia low that had formed at 8:12 p.m. Wait for that. So we're going to just mark out these liquidity areas, because in a lot of cases, like I myself wouldn't have been awake during the beginning of London session unless I was up at 12 o'clock PST. But let's see what happens here, right? When I'm looking for a trade, I want to see a sweep of a session high or where liquidity is. And in this example, we have this liquidity that's pooling up here, waiting for orders to get filled at 20,092. So we're just going to let this play out because there's currently no trade on my end, right? I want to wait until liquidity has been swept on one session. And so here we see we have our first confirmation of that Asia session liquidity being swept, right? So what do I want to wait for here? Well, now that I've gotten this session sweep, I either wait for an anticipation of a continuation higher by using a breaker block, or I want to see whether or not we have this liquidity formed paired with a session change in state of delivery on this 3-minute for a potential confirmation lower, right? Because now that we have swept these Asia highs, we can potentially anticipate London pulling back to these London lows and these Asia lows. So we're going to let this trade play out and just see what happens with market, right? Liquidity gets swept, and what happens here? Well, lucky for us, if we just break this down a little bit on a shorter time frame, what do we notice about this? Well, this is a 2 up close candle that had formed off of the Asia liquidity sweep, and so this is actually a change in state of delivery, right? Even though that is a very minuscule sell candle, it is still a sell candle. And so now look at our model. We have swept Asia session high, right? We have swept that current Asia session high during this New York session or London session. And now we have filled that liquidity and we have created a change in state of delivery, which conveniently enough, look what happens here. We have cleared this change in state of delivery and had a candle body closure on that 3-minute time frame. And so because my model says we want to look for a liquidity sweep paired with a change in state of delivery with a candle confirmation, we want to now enter this position as a short. Okay, so we're going to enter this position with our stop loss at that high, right? So here we're risking about 40 points once again. But what do I want to find? I want to find that 2-to-1 risk to reward ratio. So there's our 2-to-1. Okay, and we have now entered this trade for a short position. My stop loss is always going to be at that high of the change in state in the bearish example, with my take profit at that 2-to-1. Okay, so now we have created, oh, I don't know why that didn't work. Sorry about that. Give me 1 second here. We're going to sell another position, stop loss at the high, take profit at the low. Okay, well, it doesn't really want to work out right now. But we'll just say we took this position, right? And so we don't want market to have a candle body closure above this market high, because if we close back above that Asia high, we can anticipate market moving higher. And so we've entered this position, which we'll say we entered right at this line here. So I'm actually just going to draw this line and make it red so you guys know where we entered. We entered right at 20,060, and we don't want market to go above 20,100.25. So we'll let this play out now and see what happens here, right? This change in state gets almost retested here, but we still have a confirmation because, look, bulls are not closing back above that change in state, and so this is still a very much so valid trade, right? So just let this play out here. There we go. See, bulls are clearly not strong enough. We're not having any aggressive candle body closure to the bull side. We get another bearish close confirmation, and then we'll let this play out. Okay, we see here we had swept off of, and look what this is. We had swept off of that liquidity. We bounced off of that Asia session low liquidity. So if you had targeted that Asia session low, that could have been a beautiful take profit area for you as well, right? And this is still a very valid trade, right? Still haven't had any confirmation, and there we go, right? And so look what happens here. A perfect, once again, 2-to-1 risk reward trade was complete. Because what did we see? We saw a sweep of a previous session high and Asia high. Session highs and session lows like Asia, London, and New York all have liquidity pooling at those highs and lows. And so when you look for newer sessions like London or New York, typically it's really good to try and enter if you have a change in state of delivery confirmation of one of those sessions. And so here we have this change in state that had formed on the 3-minute time frame. We enter on that candle body closure, risking X amount, in this example 39.5 points, with the anticipation of making 79.25. And here what happened? We had that closure, we entered, we retested that change in state, we had continued bearish confirmation. We actually filled some liquidity at that Asia session low, pulled back up to our break even, and then had a full close confirmation lower. And so in an example, if you didn't get that full 2-to-1, and let's say you didn't have high confidence in that model, you could have also exited for a 1-to-1. But with my model, I always look for that 2-to-1 risk to reward ratio. And in this example, we finally had that close, that candle close that had filled our position at a perfect 2-to-1 risk to reward. And so this again would have been another A+ trade setup. And the reason being, just to break this down once again, we had swept a session high. London swept these Asia highs, and we paired that with a change in state of delivery on the 3-minute time frame with that candle body closure, and our stop loss being at that change in state of delivery candle body high, and our take profit being at a 2-to-1 risk reward ratio. So this once again was another bearish example, which yielded another beautiful 2-to-1 risk reward ratio. So there we've covered 3 bullish examples and 1 bearish example for the fractal model and how I utilize it. So just to end off the backtesting session before I get into a little question session, I just need to end the live in just a second here. The most important things to look for when you are looking for this fractal once again is you want to see liquidity being swept. As I'd mentioned with that trade that did not work out, the reason why it did not work out is because we were inside of a range, right? Typically, liquidity inside of a range is a lot less aggressive, and so you typically will see change in state of deliveries form within a range, but it's not as high confidence because a lot of those institutional market orders and whale orders are pooling above those session highs and lows, as well as more aggressive higher time frame highs and lows, like the hourly and the 4-hour session lows, right? That is where you truly want to see liquidity pooling and see a confirmation of continuation lower, right? And so to reiterate, we want to see liquidity be swept on a higher time frame, have that confirmation on a lower time frame that liquidity is being swept, and then we want to see a continuation and confirmation of that change in state if we have that candle body closure for a continuation lower or higher. So that's kind of the fractal and how that works. And yeah, so that's the main model. And then Vance, I do see your question about providing continuation using a breaker. I'll go through that in just a second. I'm just gonna end this live for the main model, and then I'll do a little question Q&A. We'll do more breaker examples on the next backtesting session. But yeah, so this kind of covers the basis of the fractal model and how you can yield consistent 2-to-1 risk to reward ratio trades. The one thing to note is you have to have confidence in the model if you truly want to start seeing results, right? If you are down, a couple points, 10 points, 15 points, but your maximum stop loss is at 30 points, there's no reason to exit the position. If you entered a trade with the fractal model, anticipating making a 2-to-1, but you're only now gonna risk 0.3R and then make 2R, that's a low confidence trade because you don't have confidence in the model, and there's a chance that you get stopped out and then your trade runs without you, right? So it's really important that when you enter and exit these trades, you know the risk in which you're going to have during a trade and prioritize that model and your 2-to-1 risk to reward. Because if the confluence is lining up, if that liquidity is swept, that change in state is forming, that SMT divergence is formed with a correlating asset, you have all the confluence that yields a consistent percentage, right? The fractal has above a 75% win rate when those 3 confluences have aligned, and so you should anticipate that the market will eventually fill out your position at your 2-to-1. There's no reason to exit it sooner unless you really need to go somewhere or not, but you should know how to manage your risk and the amount that you're managing and risking per potential trade. So just wanted to end off with that really quick, and then we'll go into questions in just a sec. I'm just going to end the live. Yeah, so I hope you all enjoyed this backtesting session. We'll get into a Q&A in just a second here, but I hope you all enjoyed once again, and I'll see you guys in the next one.